How's it going, guys? This is Adil with the Investment Circle. And today I wanted to talk to you guys about how you can begin being exposed to the market even if you're an absolute beginner. Now, when I first started investing in stocks and bonds, mutual, anything, when I first started investing, I had absolutely no idea what I was doing. I would just pick a random stock, pick a company, and I would think, oh, I've heard that name before, let me invest in it. It's sunny out, I should invest today. It started raining today, maybe I shouldn't invest in that company. I had the most terrible reasons to invest in companies. And I'm sure if you're like me, you probably want to be involved in the markets because you see everyone else making money. And you want to be one of those people that's also making money off the markets. So when you're first starting out, the number one recommendation I can have for you is to at least have some exposure to the markets. The reason for that is compound interest can only work if you let it. If we are keeping ourselves from being exposed to the markets, we are keeping ourselves from allowing 10% growth yearly to be compounded every year, right? So first off, what I want to say is when we're going to be starting this out, what we're going to take a look at is if, not all of us have a lot of money starting out. So let's say, for example, that we have instead $10,000 to start, right? Because if you're saving, between 20 to 30% of your paychecks, which is what I had to do initially when I started, then you will be able to save $10,000 a lot faster than you know. Cut down your costs, maybe just stick to just Netflix for a while, no more movie theaters. You have to make this work for you, and I can't decide what that looks like for you, but I know one thing, my girlfriend loved eating out all the time. We just couldn't do it anymore. We stopped eating out all the time. It was a waste of money. We were eating worse food. Now we cook at home. We have fun cooking. It's like a team thing. Honestly, she does a lot more of it than me, but what are you gonna do? So if we're starting out with 10,000, the percentages that you're gonna see in this video, right? If it's 30%, what you're gonna do is multiply by 0.3, right? Because 30% is 0.3 out of 1 being the whole, right? So it's 30% of 10,000, which would be $3,000, right? So $3,000 you want allocated to whatever stock ticker that we pick for the 30%, right? Instead, let's say you have $5,000, right? And the number says to invest 10%, right? Then you multiply by 0.1, right? And you invest $500 in whatever stocks it says to invest in, okay? And this is how you create what is called a portfolio, right? So the reason I want you to do this is it gets you used to buying stocks, right? Doing some research, learning how symbols work, right? This is for absolute beginners, okay? And it also allows you to be exposed to the market, right? While protecting your downside considerably. So the way that I went about deciding what basket to use for this has a lot to do with what the expense ratios are for these various ETFs. And then, I like companies that have a good track record, that have been doing a good job for a long time. So first, we want to start out with a basket that allows us to have exposure to all the stocks that are doing well in the market. And we're going to start out with VU. Very low expense ratio, fantastic S&P 500 tracker, which means it moves kind of in accordance with how the S&P 500 moves. If we look at, over the past 5 years, it has had a continuous rise upwards. We've obviously been in the largest bull market that we've had in quite some time, but it's great. It just is a part of the market you need to be exposed to. So when you're first starting out, I think you really need to think about, having some S&P 500 exposure. I like 30% for this portfolio basket. And the ticker for that is VOO, and we have 30% for that allocation. Next, we have VWO in emerging markets. VWO is similar in the fact that it tracks the emerging markets, and instead of being something that's looking at the American stocks, we're looking at the emerging markets in the world. I think this is going to be a sector of the economy that is going to grow in the coming years. So I think that you need to have an exposure to these emerging markets. Again, Vanguard is fantastic with what they do. Over the past 5 years, the emerging markets have taken a beating. It's kind of sitting at where it was at previously. But I think in the next 5 years, after the global calamity comes to an end, we are going to be looking at a growth period again for these emerging markets. So that's a 10% allocation that you're going to set away to the emerging markets. Next, we're going to take a look at VB. VB is the small cap index. And now, I know that we just invested in the S&P 500. What's going on? Why are we doing small cap? So the reason we want to invest in small caps is some of those companies in the S&P 500, right? They're like the behemoths, the Apples of the world. They take up a huge chunk of the S&P 500, right? And so we want to still be invested in some of those smaller companies that have room to grow, right? That they haven't yet reached a point of market saturation. And so the reason that I picked the VB is, again, Vanguard has a very low expense ratio for this, and it makes it so that it's worth it, in my opinion, to invest. Its expense ratio is 0.05%. If you compare that to a hedge fund, you're rich already. Okay. Some hedge funds like Renaissance Capital might get you 29% a year. Something a little hard to do with a VB, but it's absolutely fantastic. If we look at it over 5 years, it has done a great job as well. Just take a look at that. So I think you have to be exposed to some of these smaller market caps companies. Next, we're going to invest in VNQ. VNQ as well. The real estate sector, has had a bit of a cooling off period. VNQ has not done as well as we would like, but this is a basket. We're expecting that some of these ETFs are not going to do as well, but that's okay, right? We want to just be exposed to all of them because when one goes up, another might be going down. They all kind of balance each other out so that overall, year to year, we're able to gain about 5 to 9% a year. That's our goal because we want that to compound year over year, or at least month over month, while you're learning how to invest in stock options, while you're learning how to invest in different products that you're more sure of, right? And that's going to take time and research. You need to research the company before it starts growing, okay? Which is hard to do. Just a few months ago, right, I had invested in Roku, right? Roku was at around $50 a share. To me, it was a no-brainer, right? It went up, but then it peaked, right? It reached about 150. Now it's on its way back down ever since Apple decided that they're going to release Apple TV at only $4.99. Now, to me, it doesn't make that much sense that it's gone down so much because I think that Roku doesn't actually compete with Apple per se, but the market doesn't agree, right? And what's funny is the market can be wrong a lot longer than you have money to continue being right. So you don't want to invest thinking, I'm right. As an investor, you need to be able to pivot very quickly, right? So with Roku, I decided very quickly. So I saw it making a precipitous decline. I got out of it, and now I'm back in investing in different companies so that I can still have exposure to the markets, right? But I'm not going to stick to an idea that doesn't work anymore. If we look at VNQ now, sorry, going off on a tangent. Going back to VNQ, it over 5 years, it's had its ups, it's had its downs. It was at 80, 57. It is up $13 right over the last 5 years. But you see right here, it did have a huge selling off, another huge selling off. For me, what I like to do is I see something selling off, I get out of it. I'm gonna be honest with you. I'm tracking whatever I'm investing in all the time. So if you see something, having a precipitous decline in a day, maybe get away from it. If it looks like the sector, and we're talking about sector analysis a little bit later, if it looks like the sector's cooling off, it might make sense to rotate to a different sector. So we're gonna go over those things a little bit later. This is just, one of my buddies, Mike, shout out Mike, wanted to know, starting out, what should I get involved in? And this video is for that. Yeah, and so next is going to be GSG, which is going to give you broad exposure to commodities. This again has not been doing well recently. If we look at its performance, it's been getting killed, right? Oil's been down, we all know that. So of course, then commodities as a whole in a basket not going to be doing so well since a lot of these plays are oil and gas related. But for the upside, it is up year to date 9%. It is slowly making its way out of the pain that it had been experiencing for the last few years. So this is the reason that we're including it in the basket. It's only at $15 right now. 5 years ago it was at about $25. So it is down substantially. But I think in the next 5 years, oil, gas will have a recovery. So I think for me, I would like to be invested in GSG. If you're more of a gold fanatic, I think over here you could use another ETF called GLD instead. That is the Spider Gold ETF. Again, this has had fantastic year-to-date returns because we know gold has been on the upswing for quite some time now. But you can really, choose to play with this. Go with what makes sense to you. I'm telling you what makes sense to me. For you, if you're investing in ETFs, large baskets, indexes, you don't really have to worry. Sorry about that. Really weird. Someone just knocking on my door, but not my front door. That door. Anyway, so I'm gonna keep going with my distraction. So make this your own, okay? The next two allocations that we're gonna use are both in the bonds category. There's a pullback. You wanna make sure to be protected, and that's what bonds do for us. So we're gonna first use high yield corporate bonds, which is SHYG is the ticker symbol. 15% allocation. So again, if you have $100,000, you're gonna invest $15,000 into this. Let's go take a look at SHYG. Again, over the last 5-year periods, bonds have not done that great, right? We know that. It's obvious because the stock market's done fantastic, right? But if there's a significant pullback, this is definitely going to save your behind, okay? So make sure you have some exposure to bonds. In this, because it's a passive, a very beginner's portfolio, we have 30% exposure to bonds. The other 15% is going to be allocated to government bonds. And government bonds are basically these, treasuries. They're the coupons that, we know we are going to receive that money because the United States, generally speaking, they like paying people, right? When they say they're going to pay you, they pay you. So if you look, VGLT is Vanguard's long-term treasury index fund. Its expense ratio, again, like the other Vanguard products, is 0.07. So low. So over the last few years, this has done actually not that poorly. It's actually done pretty well for a treasury index product. And that's because we look at from October 1st, 2018, when we had that crash. Since then, people really have not gotten that full trust back into the market yet. After we had that pullback, that really scary pullback at the end of 2018. So we're waiting right now, right, to see exactly what's going to happen, where the market's at kind of uneasy footing. But that's why we want to be invested in all these other ETFs to allow us to have that exposure while still making some profits, right? We're just going to have our money doing what it needs to in the market. Lately, we have gotten, very recently, some pretty good news. It seems like, we're making some inroads in terms of the trade war. Whether this is just, Trump and Xi Jinping, they are very, I think they're polar opposites in the way they're presented, but in the way that they think, both of them really want what's best for their side for different reasons. I feel like Trump, for him, it's a lot to do with ego, and he wants, he wants the American economy to do well for his own ego's sake. So he can say, look, I was president and I did all of this for Americans. I don't want to turn this again into a political debate. I feel like the market has done absolutely fantastic under Trump. So whether you like his policies or not, if he's putting more money into your pocket, that should be something that matters to you, right? And he has definitely not put us into another war, which I am very grateful for. Next was Xi Jinping. He cares a lot about how China is perceived in the world. So I think, this is going to be a really a battle of the two bulls. And if they're able to, set aside their differences and realize, China might be better than America at AI, while America is better at, different like financial services, maybe we can work together. If they're able to, work something out in that regard, I think it would do fantastic for us as a whole. So I'm waiting to see, fingers crossed. I'm hoping there's no more trade war. Tariffs, in my opinion, don't really help anyone. It's complicated, but sometimes they're needed. China has decided not to allow Google, Slack, a host of companies to operate there in China, which I think is very, very unfair, right? They've allowed basically Chinese competitors to make the exact same product again, taking the intellectual property from America and repurposing it as a Chinese brand. And I don't like that at all. I do not think that's fair. We should be in a society that is fair. And I'm not sure that, though China tries to appear to be moving towards that direction, in some ways I don't think it's fair. But anyway, that's outside of the realm of this topic. What we're looking for, let's talk about how you can increase your investments, right? And so this is a great way for you to make sure that you have leverage while at the same time you have exposure to the different ways that we're going to make money here on this channel. A portion of my money, I want it to be creating capital, using other people's ideas. But a portion of it, I am expecting that I myself know how to run a business and I can put that capital to good use myself. Okay, so the rest of that money, I think, should be focused on running your own business. And so anyway, we're going to take a look at some of those things a little later. And I'm looking forward to hearing from you guys some. If you could please like and subscribe. If you have any questions, shoot a comment below. Anything else, I'm really, really happy to keep doing this. And I'm grateful that you guys are watching, man. Awesome.